When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about today's financial markets, Fed policies, inflation, and politics, what retirees need to know today. We'll also answer listener questions. And then finally, is your 401k actually ready for retirement, or are you just hoping it is? My name's Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. Always fun to be with you.
Always fun to be with you as well, too, Jeff, and with all of our fine listeners here in the greater Tucson area. So let's talk about today's financial markets, Jeff. I mean, everywhere people turn right now, they're hearing about inflation, interest rates, tariffs, geopolitical instability, recession fears, and political uncertainty. A lot of retirees here in Tucson are nervous. What is the big picture right now for people nearing retirement or already in retirement?
Well, again, I always go back to, if you have a plan, you shouldn't worry. If you plan to retire, you ought to have a plan. If you don't have a plan, you're kind of planning failure, in my opinion, because there's just too many things that are unknown that'll happen along the way. Earlier this week, we had the inflation numbers come in pretty hot. I mean, 3.8 as opposed to 3.2 in March. That means they're getting worse. Most of it is attributed to gas prices, obviously, and that's about 50% of the overall inflation is due to 50% raise in gas prices, if we think about it. The energy sector and gasoline, as far as a percentage of the inflation numbers, 28%. Gas prices, airline fares up 20%. Retirees like to travel. They like to drive places. So that's going to affect them from the standpoint of that inflation is going to affect them pretty directly. Now, if we look at food, which is also affected by prices of gas, the biggest ones were tomatoes and coffee. I mean, tomatoes are up 40% from an annual basis, coffee up 22%, beef 17%. Those are big numbers when those are the things that people eat on a regular basis. Meat, tomatoes, and, well, I don't see potatoes on here. Meat, potatoes, I guess fresh vegetables are up 11. That's not good. Hot dogs are up 10. Anyway, it's not a good number when you're looking at the type of things that are increasing in prices. If it happened to be recreational properties or cabins or RVs and that kind of thing, which are totally discretionary, you wouldn't think too much about it because you can still get by without all those things. But you can't get by without, well, some people could get by without coffee, but coffee is a pretty important thing to most people in the morning, get them going, and beef. It's one of those staple foods that people like to eat. So we saw inflation go up. We haven't seen really robust numbers in the jobs market, the job creation, the job increases, the salary increases, things like that are not looking very good. More and more people are struggling to make ends meet. Debt and everything from mortgage defaults and refinances and credit card defaults are higher than ever. Even margin buying on the stock market, people borrowing money even to buy stocks to try to keep propping them up, is at an all-time high. So we've got a lot of things that are worrisome. And I've said this before, this is not anything new for the last few years. I thought when 2022 happened and the market started crashing, it got interrupted by some creative money printing and a bunch of BS and market manipulation. And we started coming around and there was no earnings to speak of for the first couple of years. We're finally now starting to see earnings, but now they're projecting these earnings to go through the roof forever based on predictions and hype. And the market continues to roll forward at unprecedented levels. So much so that one sector, the tech sector, semiconductors mainly, drove the entire index, all the indexes. There's 11 sectors in the market, yet only one is probably driving everything. The healthcare sector took about a seat. I think it might start popping again. Consumer staples maybe start popping again a little bit. But the things, the cycles, it isn't just cycling or spreading itself out amongst the sectors. It's very thinly traded and very overbought. I think there was a 60% growth in just the last few months in the semiconductor sector, which means there's probably going to be a sell-off. So there's a lot of things that are worrisome, especially in light of the fact that inflation numbers are not looking good. Inflation generally requires or ends up with the Fed increasing interest rates, not lowering them, and increasing interest rates, especially with people with variable loans, companies that have to borrow money on a variable basis, meaning they have to pay whatever the current interest rate is. They don't get to lock in their rates forever in most cases. So all these companies need new debt. So if they're going to borrow at a higher and higher rate, then that's going to exacerbate the inflation. It's going to make things cost so much that nobody can afford to buy them. And then there'll be a recession, which is really the end result of all the things that we've been seeing, this bubble, an everything bubble, as most people call it. Warren Buffett's going into cash. He's somewhere between 30 and 40% cash in Berkshire Hathaway. They got Ray Dalio, his group, biggest hedge fund on the planet, I believe, still, and they're raising cash. So all the smart money is raising cash. You see a lot of the smart money going to the bond market, even though the bond market's been very soft, but it's a lot more stable than a 50% market crash if semiconductors sell off and take the market with it. So the semiconductors, mostly chip business, which is going to drive the AI. The energy sector really did well last year, and it's been on pause for a while. A little bit of energy. Some of the energy companies have bounced a little bit, but in general, you see a lot of the energy companies that were the talk of the town a year ago aren't even in the conversation anymore. So we're seeing the sectors that are driving AI come and go, and we're seeing the chip sector be the hot one right now. I think there will still be a market for the chip sector, but who's going to get all the market share? It seems like every company is pricing in 100% market share of whatever they're dominant in, or even what they're not dominant in. Every chip company thinks they're going to get 100% of the chip sales. Well, they're not. They're going to have to share them with all the other chip companies. So it remains to be seen what shakes out, but I've been saying for a while, we're due for a crash. We never really finished the one we started in 2022. Nevertheless, we've been making good headway in the market by managing very carefully, by getting up early every morning and watching what's going on in the market, watching where the money's moving from and to. We're keeping an eye on that. But, it's still worrisome. In fact, I'm probably spending more time looking at the market now than I have been in the past, just because it's really in such a precarious position. I feel that we have to be a lot more careful with money right now, especially the money that's at risk. Now, the good part about planning and the way we set up plans is the money that you have at risk isn't the money that you use for monthly bills anyway. So it shouldn't matter if you have a bad day or a bad month or even a bad year from time to time. We had about a half of a bad year in 2022. And honestly, we were late getting back in because we were kind of waiting for the market to correct. But the thing is if you have a plan where you have income coming from annuities and LIRPs and things that are generally either guaranteed income or predictable income and have principal protection, make money when the market's good, don't lose money when the market's bad. When the market overperformed, we still made money on those things, even though we were being very defensive and not quite so aggressive in the market. And then we got aggressive, did really well. And now we're looking at being very, very careful and being really ready to be defensive at any minute. So again, if you have an advisor that's steering the ship and you can ride on the boat and enjoy the ride, great. If you are doing this yourself, I don't know that I've seen a more difficult time to keep all the plates spinning and see all the stuff that's going on. There is so much gamesmanship in the market nowadays. AI is a new player in the game, betting against you, betting against your trades. There's algorithms that are making the market interesting. We have margin buying at all-time levels, meaning that the brokerage firms will loan anybody, even kids in a basement, trading on their iPhones on Robinhood accounts, will loan them money to buy stocks. I might be exaggerating a little bit there, but it seems to be a little bit out of control. So I think going into a time when everything's kind of perched precariously on the edge of a cliff, and now we get high inflation, which generally leads to tightening of monetary policy. It may or may not. I don't know what the new Fed chairman's going to do. We'll have to see. Jerome Powell I guess he took pride in not kissing Trump's rear and doing everything he said. And I think in retrospect, probably smart to do so. I think if we'd have lowered interest rates, we would have caused incredible inflationary pressures, probably much higher stock market if Trump would have had his way. But then again, he's got investments. All his friends are investors. The stock market making new highs all the time is kind of a good thing for a president to tout at any speech that they give about the economy or whatever. So, I get what the president wants. I get what the economy wants. I see what the economy is doing, however, and it's definitely worrisome. So again, we had some interesting things happen just with the recent data. We've also got the Strait of Hormuz problem with the Iran war. That's not anything that's friendly to the stock market yet. Doesn't seem to be hurting. It seems the stock market just shrugs it off and moves on. So I'm not sure if the weakness we saw in the market this week with the inflation numbers is just the start of things to come, or if we're going to just bounce right out of it, or if we're just going to have a couple of what we call those dead cat bounces, and we're actually turning the corner into a downtrend. So again, it's important to be watching that if you do have money at risk, or at least have somebody you trust watching it for you that understands your risk tolerance and how much you can withstand as far as market risk, losses, volatility, and hopefully whatever you have in the market at this point is not jeopardizing, or a market crash would not jeopardize your income or your peace of mind or your ability to live life on your terms. So going back to your question, with all these geopolitical issues, recession fears, I've got fears. I've had recession fears for 3 or 4 years. It's bound to happen. Every indicator says we're going to have one. And, am I Chicken Little, the sky is falling? No, we're making the best of it during these times. I think our people that have managed portfolios are very happy, but also hopefully I'm taking the worry off of their shoulders to a certain degree, watching these things, and they listen to the radio. They know what I'm thinking, and most of them do. So anyway, geopolitical events, more could happen, I suppose. We don't know what's going to happen after this China trip with what's going on with Russia, Middle East, and even the European countries trying not to side with us anymore. And I don't know if Trump has quite the clout he thinks he does on the world stage, because people are getting a little bit more skeptical about what he's doing, especially with this Iranian thing, whether it's real, whether it's just driven by Israel, whether it's really a real threat. We have to just assume that behind the closed doors, our government leaders know what's really happening and are doing the right thing for us. We elect them to do that. But the more I watch it, the more I'm skeptical that anything's in our best interest. And I don't know who's the benefactor of it. But bottom line is, we've got to see the big picture. We got to make a plan so that no matter what happens, that your financial house is in order, that the foundation is set, that the walls are built strong, and the roof's not going to blow off in the next market correction.
Well, Jeff, I think the big takeaway from our conversation here today is that retirement planning has become more complicated because retirees are now dealing with multiple risks all at once. We've got stubborn inflation. We saw it going down. Now it's made a U-turn. It's coming back up. And Kevin Warsh says that more than likely we're not going to reduce interest rates this year. We've got market volatility. You were up early in the morning trying to head off some losses, rising healthcare costs, and political uncertainty. Did you see any of this coming our way, Jeff, at the turn of the year, 2025 turning into 26? And what do you see for the future? More of the same here for the rest of this year? I know you don't have a crystal ball, but what do you think?
Well, you know, at the turn of the year, the markets had been soft for 3 or 4 months, and they've stayed soft. And we just had this crazy, in fact, the market indexes sold off about 10% or more between January and March, and then they kind of zoomed back and went back to these new highs. Now, the new highs are not substantially new. I mean, they're only a few percent higher than the old new highs, even if you add up the last 50 new highs, because they're just very small increments. But the fact is we're back up to a high point, and it got there so quick. It's just kind of an unprecedented sharp upswing. It just doesn't usually go up that fast. It typically goes down that fast. But there was just a ton of money, and I think market manipulation that went on to get those indexes back up, again, driven by the semiconductor industry mostly. Was it helped out by some good earnings reports? Yeah, there's some companies that have gotten involved in the AI and are merging and making deals and committing all their chip sales or purchases from certain companies, and that's making the market look pretty strong. So whether it is long-term or not, that remains to be seen. But yeah, at the first of the year, it was weak. I kind of was thinking that smart money was just going to keep following the gold and silver, and we did very good in that in the first couple of months, and then it sold off, you know, in the rotation back to the tech markets. You know, we haven't even seen strength come back in the gold and silver market, which I thought was probably going to continue, and it may, but I'm getting a little more skeptical about that now too. It depends if central banks are going to keep propping those prices up. Gold was well over $5,000 an ounce, and now it's in the high fours, but it's not even close to 5 yet. We had silver, now it's in the 80 range. It was down in the 70s after it had gone up to 107. I remember the last time I saw a quote, we've taken advantage of those upswings, but we're still kind of waiting for the next rotation into probably the defensive sectors, and that gives us a little bit more indication that smart money's getting a little bit wary of the market and that we might want to follow their lead. We've already seen a lot of smart money going to cash, a lot of smart money going to bonds. It seems to be maybe a lot of it was profit taking from the gold and silver sector, but that might end up being another hedge if the market gets a little squirrely. The market is a squirrely place, and every once in a while you just have to kind of take a deep breath, kind of reassess where things are. I think if you're working and you're just a close your eyes and set it and forget it investor, just go with the indexes and know that in 20 or 30 or 40 years, everything's going to be okay. But if you're needing that money here and there and you want that money to grow and you don't want it to take any big losses because you might need it at any given time, we don't want you to put the money you might need tomorrow in the market. But the bottom line is we don't want to take big losses along the way, but we also want to take advantage of those upsides when they're there. And we've seen some crazy markets lately. Sometimes they go up with no reason, and sometimes they go down with no reason, and sometimes you have a reason to go down and they still don't. You know, to make rhyme or reason out of the market's kind of a crazy thing. It's a mind game and certainly keeps you on your toes. But let's see going forward. Is the market going to get better? I just heard somebody, a pretty well-known person, I won't name names, but you can probably Google. There's a few gurus that are pretty well market savvy that think this 60% run-up in the semiconductors is going to result in probably a 40 or 50% retraction in that sector for the rest of the year. That'll definitely, because it's such a big part of the market, it's probably going to be the catalyst of any type of market or a sell-off that would affect the indexes overall. And we may be seeing the start of that. There's an old adage that you go away in May because the summertime is usually a soft spot in the market, and the market usually does the best between November and May, which we've kind of been through. The November through March wasn't very good, but the March through May was, or at least the first part of May was good, till this week. Yeah, we'll just see where it goes from here. I don't know that we're going to get that renewed buying like we did in April, but yeah, we might. we'll just have to see how it goes and see day to day. I mean, you really can't predict it. So my opinion is the market's got to correct eventually. I don't know when that'll happen, but we're going to be watching and we're going to be ready.
Well, Jeff, inflation is still eating away at retirement income. Taxes are rising. Markets are volatile. A lot of people in our listening area here in Tucson are asking the same question. Am I really prepared for retirement, or am I just hoping that everything works out? Well, that's why Jeff here and the team at Premier Retirement Planning are offering their complimentary Premier Retirement Roadmap. It's a customized retirement review designed to help you answer some really critical questions like, will your money last? Are you paying unnecessary taxes? Could inflation derail your retirement income? Are you taking too much market risk right now? So if you've saved at least $500,000 for retirement, this could be one of the most important phone calls that you'll make all year. It's 520-780-9059, 520-780-9059. Call now for your complimentary Premier Retirement Roadmap, no cost and no obligation. You can also find out more about us online at premret.com. That's premret.com. All right, Jeff, let's get back to our conversation. For someone listening right now here in the Tucson area who's worried about inflation, taxes, market volatility, and whether they can truly retire comfortably, what should they be doing next?
Calling us. I mean, it's what we do. We walk people through a plan where you can take all the guaranteed income sources you have, add some of your investments to more guaranteed income sources, at least know what your spending plan can be on a guaranteed basis, and then the what if money can be invested to your liking. While we do that, we also know that paying the government a big chunk of your money is not a wise thing because they don't spend it as wisely as you do. So we would say saving taxes is a big part of that distribution program to make it as tax efficient as possible, to make sure that you're not overpaying Uncle Sam and you're keeping most of the money that you've earned and worked a lifetime for in your family and in your community, doing the things that you want to do, working for you, not you working for it, and then basically working for the government half a year. So you did that while you were working. We don't want you to do that in retirement. We want you to keep everything that you can. So it might require some Roth conversions from your IRAs, may require paying some taxes now on money that you will probably have to pay taxes on more money at a higher bracket later if you don't take advantage of the good tax rates that we have currently compared to what we've had in the past and what we'll probably have in the future. A good tax efficient income plan, smart investing with certain risk barriers or buffers that limit your risk on the downside or eliminate the risk on your downside. Some people don't like any risk. And now with the new indexed annuities that are out there, and indexed annuities, you don't have to hate the word annuity, even though everybody who doesn't sell them hates them. But annuities are a good thing to secure assets. A fixed annuity is not a security. It's actually a more secure product than a security. Securities have risk and fixed annuities don't. Anything that says fixed doesn't have risk. CDs don't have risk. They're also not a security. So I think they kind of use a word game to try to help us think that, money and securities are the secure way to invest, but it's absolutely the opposite. So if you want principal protection, index annuities, LIRPs have principal protection on the cash balance of the account. You have to consider the cost of any of these products. Some have fees, some don't. LIRPs have cost of insurance. So that kind of depends on your age and insurability, whether or not that makes sense. But when you take it all into consideration, how protected are you? How much income can you take? Is it tax efficient? How long will it last? And does it build an income that if you outlive your nest egg, will it continue to pay you income? And we like products like that. Social Security at this point does. Maybe they'll limit it to, sorry, you only get 30 years. Or maybe they'll say, you can't make more than X amount per year. I've heard rumors that people have heard or read that. I haven't seen that in writing, but that they're going to limit the payout. I think they're going to continue to do so. I think it might be means tested at some point, especially when the trust fund runs out in about 5 years or so. I think 5 to 7 years, they think the trust fund's actually going to go negative, where the taxpayers paying into Social Security is going to be less than the people needing Social Security. And part of that is because people are living much longer than projected, and they keep on having to give cost of living adjustments based on inflation. And with inflation going up, that means the drain or the pressure on the Social Security trust fund is going to be higher as well. So we can't do too many 9% Social Security adjustments like we did during Biden when we had that 9% inflation year on Social Security, which is pretty significant. So you can't have too many years like that and expect that trust fund to stay intact unless we either raise the Social Security taxes on businesses or employees, or we means test it for the retirees. So keep that in mind when you make those plans. But, inflation is back to that. If you're worried about all these different things and you have a plan that gives you, you're guaranteed, I have to have this much money to live. Do you have to have inflation as you go? Honestly, what I've seen, if inflation can remain at the 2 to 4 range or lower, and 2 to 4 is actually pretty average for the last 40 years. We have a few big years and a few moments where we have inflation that kind of gets out of whack, but then it usually goes back down to a normal range again. And all it takes is a recession typically to do that. We haven't had that recession because we keep on propping up the market and keep on creating more inflationary pressures in order not to have the recession, which is kind of a catch-22. Unfortunately, Recessions sound like a bad thing, but they're really a good thing because they kind of reset everything to a normal basis where we can think straight again and actually do planning that was a little less stressful, a little bit more predictable. But bottom line is there's enough things that guarantee income, that guarantee against losses, that can make you at least feel comfortable going into retirement. And then as you build an inflation plan, keep in mind that as you get older, you're going to probably be spending less on those things that are discretionary. Travel, you have to go see your grandkids now when they're little. Well, when they're big, they'll come see you, right? So you want to go to Europe every year a couple times, but pretty soon you've been to all the places you want to go and it's just too hard to travel. You don't like going there anymore, so you don't spend the big bucks on travel. Maybe you don't golf as often as you used to, so you don't need a new set of clubs every year. Whatever. Bottom line is I've seen people spend less and less in 20 and 30 years into retirement than they did when they started retirement, in spite of the fact that inflation's been at 2 to 4% for those years. And maybe the cost of living overall for a general person doing the same things as they did when they were 60s could be up 50 or 60% by then. Yet, for some reason, it's not for those people that are in their 70s, 80s, and even 90s. It seems to get a little cheaper until, of course, you move into assisted living or a care home type situation or a Splendido or a Encanto or someplace like that where you go in and have everything done for you. And that might be your final place where you just got to go in and relax. Your final resort lifestyle living is your final years, perhaps, when that gets expensive again. But bottom line is the inflation factor isn't necessarily your expenses don't have to keep up with inflation. In reality, they typically don't because you don't spend as much as you get older until you get really old and then you spend more. So it kind of goes like a U. You start out spending more and then it goes down. And inflation may affect that. But what I like to do is just kind of straight line your income. Hopefully the Social Security continue to give some cost of living adjustments. And then you have Roth IRAs. You might have some other accounts, investments and things that you can just kind of leave alone and grow. And that could be your buffer for those inflationary years or those times when you need that extra money to fix something or go on that unexpected trip when your granddaughter says she wants to get married in London and Westminster Abbey or something, and you have to go. So, and it's expensive, whatever, I'm making up stories, but you get the picture. You never know when those things might come up, happen. So you like to have that little buffer fund that can grow and be there for you rather than just tie everything up into a guaranteed income. But the best thing about coming in and getting a plan, like you said, what should somebody do? If they call us, they'll come in and get a plan. What we'll do is we'll show them a reality of what a what-if lifestyle would be. What if it could be really good and it could be really bad? Are you willing to take the chances on it being really bad just to have a potential of it being really good? And that is just keep everything in the market and hope it doesn't crash and hope you don't need your money when the market's down. Well, that probably got you to retirement, but it may not get you through retirement. So if we structure it where we've seen happy people stay happy for decades, we've kind of learned what makes people happy, and it isn't necessarily swinging for the fences anymore. It's buttoning it in singles and getting on base. It's just not getting out, right? It's winning the game by just staying on base, staying in the base pass, keeping in the game. You don't have to hit home runs. You start swinging for the fences, you strike out, and bad things could happen when you try too hard, and sometimes people in retirement do. So again, step back, assess your situation, figure out what's reasonable, and if you're not sure, then ask us, and we'll show you what's reasonable. Over the last 30 or 40 years, we figured a lot of things out. We figured out what people can typically live on. We figured out that if we have X amount in savings and X amount in Social Security and X amount in pension, that your lifestyle will be X and you'll have this much extra money as a buffer. It might be a few $100,000 now, but it might turn into millions over the period of a few decades that you'll have as a little buffer in case things don't go quite as planned. We always know things don't go quite as planned. The only thing certain about retirement is the uncertainty part of it. And there's just too many things that we can't predict. And so that's why what we do is we guarantee as many of those aspects as we can. And we plan for as many aspects as we can. We guarantee income, we plan for taxes, and we make sure that you're sitting in a good place going forward. So that no matter what happens, you're not going to wake up in the morning and go, oh my gosh, I got to go back to work, or oh my gosh, I got to move in with my kids, or oh, maybe we need to downsize, get some money out of the house. We just lost too much in the market. I don't know what's going to happen. And then you worry yourself sick, and then you end up dying from stress or something like that. So again, we want to make your retirement comfortable. But the first thing is, if you're not really sure even what your budget is, we can build you a plan and say, hey, this is a reasonable budget and this is a reasonable income plan based on what you have. We find more often when people come in, and about honestly half the people come in and say, we don't know if we can retire. What's a reasonable income plan with this asset base if we do the things that you're good at doing? And we'll show them. And we've actually had people even recently in tears going like, oh my gosh, I didn't know we'd done so well. I didn't know we were that good off. I was just wanting to scrimp and save. I never felt like I could help my kids. I never felt like I could travel as much. I didn't know I could go to Florida and see my grandbaby be born next week because I thought it would cost too much. It looks like we have plenty. And you might find out that you have plenty more, especially if you guarantee the monthly bills part, then you have a lot more to deal with on a discretionary basis where you can do those fun things and maybe build some padding for inflation or for those what-if events that come up that you don't want to have to miss. again, it's just all about living life on your own terms, but sometimes you don't even know what those terms are until you've done a plan.
Jeff, this has been a great conversation, and I remind listeners that at Premier Retirement, we help people build complete retirement strategies, not just investment accounts. So if you'd like to begin a conversation with Jeff, call 520-780-9059. It's 520-780-9059. You can also find out more about us online at premret.com. Jeff, time for a break. We'll come back here on Premier Retirement. We've got listener questions, and then later on, is your 401k actually ready for retirement, or are you just hoping it is? When our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
Thanks so much for joining us. You're listening to Premier Retirement with Jeff Vogan. My name is Jeff Shade. We're on the air for you 4 times a week on 790 KNST, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. If you have missed any of those times, you'd like to hear the show again or any of our past shows, remember we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a prosperous and confident retirement. Our phone number, 520-780-9059. That's the number you can call right now to request your Premier Retirement Roadmap. Absolutely no cost and no obligation. Okay, Jeff, time for listener questions. William's listening to us in Rancho Vistoso, and William says, my wife and I are both 63, debt-free, with $1.5 million invested and enough pension income to cover our lifestyle without touching investments. A CFP is recommending putting 30% into a fixed index annuity for risk reduction. Given that we already have guaranteed income, does that make sense? And what questions should we be asking before doing this?
Well, I just mentioned a couple of things. One is letters after your name don't necessarily mean anything unless it comes with a comprehensive plan, in my opinion. I mean, you could be a CFP, an RFC, a CEP, a CHFC. You can be just about anything, or you can not even have any designations and be an advisor that has licenses that has proven, at least basic knowledge about how to serve in the industry. So because a person is a CFP probably has anything to do with it. You have people that on TV say, we're true fiduciaries. We would never sell you an annuity because we're a true fiduciary. Somehow we're better than everybody else. And the fact is they're not true fiduciaries if they're not selling you what you need and providing answers to the questions you have. So I would say that if you aren't sure why this makes sense, then the CFP is a horrible CFP. They're not a certified financial planner because they obviously didn't give you a plan. They're just selling you something. So recommending putting 30%. I mean, did it come with a plan? Is it part of a plan? If you saw how it was a part of a plan, it might make more sense. But I will tell you how we use them in plans, and that is 30% in a fixed index annuity. We like fixed index annuities. We like the right kind of fixed index annuities. But here's the question you would ask the CFP is, are they independent? Do they actually work for a company? Who's their broker dealer? And if they have a broker dealer, then they are typically restricted on annuities that they can sell. So they're probably very limited in what they can offer you. But a fixed indexed annuity might be the right product. It may not be the right fixed indexed annuity, however. It might be the right asset. So I love fixed index annuities for principal protection. I love fixed index annuities because they are safer, in my opinion, than bonds. You could buy bonds for your fixed income from a securities advisor, from somebody that calls himself a fiduciary, but they only sell stocks and bonds. Stocks can go down and bonds can go down. We learned that. Shoot, the 20-year bond is still down over 20% from its high. Actually, I think it's more like 35% from when it peaked out a few years ago, and still having trouble getting back and making any money. So if you don't want to have risks in holding bonds, which I think you shouldn't, then you ought to allow an insurance company to buy those bonds, guarantee your principal, and invest the interest from those bonds into indexes in the market through options and other creative ways that they can do as with economies of scale as institutions, and make you more interest than a bond. So in other words, you can probably make an average of 3.5% to 5% on bonds and be at risk for volatility if you ever needed to cash in the whole bond instead of just use the interest. And by the way, 3 to 5% interest on a return is not very compelling if you ask me, because you can do a lot better than that on annuity, on fixed annuity interest. Some CDs even pay more, and a liquid a little bit more often, and don't risk principal like a bond does. So again, a bond I think is just really overrated. The only reason I think the big institutions use bonds is just because they're an easy place to park money. They also can be traded on an institutional level, and some of the big traders on Wall Street make money selling bonds, and they don't care if you lose money buying them because they're selling big blocks of bond. They're controlling the market in bonds. But if you let an insurance company buy the bond and use indexes on an annuity, then they're taking all the risk. So in other words, your bond portfolio does not have risk. Principal is protected. and it still has the upside. I mean, if you bought a collection of bonds between 1 and 10 years and you didn't want any risk, you'd have to hold them all to maturity. So some people say, well, gosh, I have a 10-year contract with an annuity. That's a long time. Well, so you'd be kind of forced to stay in those bonds for a long time. And if you sold 5 years in, if you bought this annuity in 2020 and you want to sell right now, you're going to lose 10 to 20% on your bond portfolio if you sold. So some people claim, yeah, but if I sell my annuity, I might lose 5 or 10% in penalty. Well, the insurance company will probably lose even more than that, but they're taking the risk on you. So I don't see a downside in having a fixed index annuity for the proportion of assets that you would otherwise be putting in bonds, unless you want a short-term bond like a money market type, which is basically really short-term government bonds, a super short-term, like 1 to 3 months or less, even a daily bond rate of a money market for liquidity purposes, or cash at the bank or high yield savings, something like that for a little bit of your money. But for a big chunk, you have $1.5 million, you want to put $500,000 in an index annuity, I'd say that's great. The other thing you ought to consider, which your CFP should be considering, if they're any good at their job, in my opinion, if they're not me, I don't think they're as good as me. I mean, I'm sorry that I'm, somewhat, I don't know, might sound arrogant, but I'm somewhat confident in my 40 years of experience to know, what you might also want to look at. I mean, given the fact you have $1.5 million, you probably have some decent income. You have enough pension to cover your lifestyle, so you're probably already getting enough income to put you in a decent tax bracket. And depending on how that $1.5 million is allocated, whether it's with IRA money, whether it's Roth money, or whether it's after-tax money. After-tax money would be not only protected from risk, but after-tax money, like a brokerage account, if you're going to move some of that to an annuity, it's also tax-deferred. So you only pay taxes when you pull the money out, which is really nice because bond or CD interest is taxable whether you use it or not, and I kind of don't like that. But let's just say that $1.5 million is pretty much in all IRAs and things like that. You could do some Roth conversions. You should probably put that as part of the plan. Is this annuity going to be part of that Roth conversion, or are you going to be aggressive with your Roth money and maybe just let this thing sit there with principal protection so that when you get to required minimum distribution age in 10 years or so, or 12 years for you, are you going to lock in losses if the market's down? The nice part about indexed annuities is they're only going to go up, they're going to be safe, and it's going to be a place where you can protect assets. If you added LIRPs, life insurance retirement plan, to that with non-IRA money, you might get a bigger bang for your buck, have access to cash anytime you want to without generating a 1099. And unlike an annuity, which is tax deferred, you can play the game with LIRPs on a tax-free basis. So let's say you put $500,000 into that annuity, grow to $750,000, and you want to take $100,000 out to go on a trip or buy an RV or something or help a kid out. Guess what? You made $250,000 in interest on that. The first $100,000 you pull out is going to be taxable. Well, on a LIRP, it wouldn't be. You could just actually borrow against the $750,000 cash balance and not worry about it. You don't have to pay it back till you die because there's a death benefit. This basically pays it all off for you. So doesn't generate a 1099, doesn't put you in a new tax bracket. You might want to consider that for non-IRA money or even on a conversion basis in lieu of a Roth. Generally, clients, and you would be a fairly typical client with $1 million and up in savings for retirement and decent income. You probably also have maybe knocking at the door of a tax problem, especially if you didn't touch that IRA money, $1.5 million for 10 years or more, it might be $3 million. Now you've got, $120,000 or more that you have to pull out in required minimum distributions, and you may or may not need that, but you'll have to pay taxes on that. So between now and then, you might want to consider an aggressive tax planning program where you pay taxes now on that $1.5 million, and instead of having to take money out, pushing you into a new tax bracket, paying double or triple on your IRMA, good old IRMA. You don't know about that yet, but wait till you find out when you make a certain amount of income and it's over a certain level that your Medicare premiums for Part B go up. In fact, I have some clients paying between $500 and $600 a month instead of the $180 a month that most people pay. So there's a lot of reasons you ought to look at your situation right now and start having a long-term plan, not just, hey, let's just sell you an annuity because there's a nice chance to get some money off the table, make a little commission, and sell you a product. Now, we sell products, I guess, if you want to say we provide solutions, and it does include products. But absent the plan, you should run. You shouldn't do anything without a plan or how this is going to work. When am I going to use it? What's it for? Is it just because I have CDs I don't like or bonds I don't like, and this is an alternative, so let's just find you another product. Here you go. Call me when you need something else. I don't think anybody should call themselves a financial advisor or anything with 3 letters after their name if they're not giving you a plan or telling you the context. So just the very fact that you call me and ask me what questions you should be asking means that you should come to see me in the first place. If you're asking me, not the person that's offering you. And maybe they just happen to be referred to you and you decided to listen to them and they go, why is that? So again, and I'm not saying just me, there's a lot of people that I think are a little bit more comprehensive in the planning that they do that offer the securities, the more of a planning approach, but the tax approach. CFPs unlike CPAs, and by the way, CPAs don't do tax planning a lot. They only do tax preparation mostly. But just because a CPA is a tax guy doesn't mean they do any tax planning. Just because a CFP means a certified financial planner or a certified financial professional is what they're trying to call themselves now, because I don't think they really do planning as much, or kind of indicated that you should always have a plan. And I don't think that was always the case, depending on who you work for and what they restricted you to do. So the planning part is what should accompany any product sale or product purchase, in my opinion. If you don't know how it fits into a plan, then don't do it.
William, very good question. We appreciate you listening to us there in Rancho Vistosa. Once again, if you would like to continue this conversation with Jeff, 520-780-9059 is the number. We would love to meet you. Okay, Jeff, Sam is listening to us in Tucson. Sam says, I'm 60 and retired, and I run my retirement plan using two longevity assumptions, my actuarial life expectancy and age 90. My Monte Carlo results look strong on both ages, which makes me wonder if I'm being too conservative with spending. Do you think retirees should plan around both statistical life expectancy and a longer, what if I live in my 90s scenario?
Well, I think a lot of people live way past their 90s. I've had too many clients that have already exceeded by decades their initial life expectancy when I met them in their 60s. Oh, well, nobody in my family's ever made it past 75, so I'm not going to. And now they're 90, going like, oh my gosh, I can't believe I'm still here. Because there's things that, first of all, genetics aren't always the only thing. It could be environmental hazard. You know, was their dad and grandpa a coal miner and got black lung, or did they smoke like a chimney and you don't, and you exercise and eat healthy and go to the doctor and take care of yourself? I mean, there might be reasons you think that you have an actuarial life and a 90-year life expectancy, but all of our plans go to at least 100 and have money left over at 100. The reason being is because if we used a Monte Carlo simulation, because it generally really only speaks to stocks and bonds and mutual funds and the things that you look at the company like T. Rowe Price or the Fidelity or Vanguard site where you can do those little analysis and plug in all your income and different assumptions, it gives you a score. Like, you know, you have 78% chance you'll still have money at age 96, but you have like a 99% chance that you'll have money at 90. Well, okay, it works great at 90. Does that mean you should spend more because you're pretty sure you're going to live at 90? Well, maybe you should spend less just because you only have a 78% chance of not running out of money if you live to your mid to late 90s. Well, what if you go to 100? The thing that's different about the way we plan, by the way, I've never seen a Monte Carlo simulation that says you can live on X. And I use this in my book and my seminars. I think I've mentioned in both places that, you know, I had a client come in, they wanted to live on $150,000 and they went on the Monte Carlo simulation. They had about $3 million in assets, and it said that they had like a 78% chance that they'd be okay till the wife, who was younger and healthier, was going to be 95. By the way, her mother just passed away and she was just a few months shy of 100. So she'll probably be past 95 because she's in way better shape. Looks like she's doing a lot better than her mom, who is also a client of ours. But bottom line is, they came in, they were a little worried about that 78%. Well, what we did by maneuvering their money, paying some taxes, giving them some guaranteed income, and lowering their overall risk, we ended up giving a $250,000 income with almost no chance of running out of money at those ages, even to 100. So we can do better. And honestly, by the way, Monte Carlo is not built by annuity companies. They're built by, you know, companies that want to risk your money and tell you you're going to be okay. Just go ahead and leave it at risk. Just spend less so we can continue to get fees and trade your stocks forever. Monte Carlo is really a securities world or a Wall Street tool to see if you're going to be okay to make it. It takes into consideration all kinds of different scenarios of sequence of return risk and the what if scenarios, and you can change the average rate of returns on bonds. Thing is we don't know what the future holds. We might go back to a zero bond environment where bond interest isn't going to do well enough to make you enough money over the long haul to live past 90. What if you locked in today's rate and got an income based on today's rate forever? And that's why you would want to use an annuity. That would actually give you a higher rate of life expectancy, or as having money at a higher spending rate through your life expectancy. So again, combining assets with IUL, LIRPs, and annuities and the market, your money will last longer. In fact, Ernst & Young, one of the big four accounting firms, just did a white paper. It's about 20 pages long. Happy to send it to you if you want a white paper. I think we should try to sit it on our website where you can actually download the link. I'll see if I can get that up there. But if you want to call our office and just leave a message that you want the white paper on longevity, Ernst & Young did a study and said the best combination, whether you're 40, 50, or 60, in planning for retirement is to include both index annuities with income riders and IUL, Index Universal Life. What is that? That's the LIRP I talk about. And I've been saying this all along because when I did the math on a spreadsheet, it just made sense. Well, Ernst & Young, an accounting firm that typically kowtows to the Wall Street models and the Wall Street firms and the big businesses, probably got a lot of flack for doing a study on actual retirement income. And it's interesting because, you know, they're a big company. They don't do personal income tax returns, yet they're talking about what's good for the average retiree and actual person that works for one of these companies that they represent, not the companies themselves that they represent. So I thought it was interesting that they kind of were conflicted in their interest, I thought, yet still came up with what I knew was the right answer, because I've been doing this for 40 years and I've played so many different scenarios on a spreadsheet and used so many different assumptions. And not only that, I've lived through, actually right before I was a stockbroker, I lived through the crash in 87, which was pretty severe. Some of you remember that. And then there was the crash, the big old bubble, a tech bubble in 2000. Then there was the bubble with the banks in 2007, 8. And then there's the little COVID bubble. Then there's this start of a downtrend in 2022. Who knows when the next big correction is? But we've had two pretty severe ones just in the recent past, in the last 25 years, that should wake people up to realize that, everything's not all rosy in retirement. You've got to make sure that you take into mind the volatility. If you take that out of there and include some income, you'll be better off. So Ernst & Young, big accounting firm, basically showed us what I've learned over the last 40 years, and that is by adding all the tools and not just doing what Wall Street says or what some guy on TV says, because they're a true fiduciary and all they do is the same plan for everybody with stocks and bonds and charge you fees forever. And they don't want you to do these things that might pay a commission, because then they can't get fees for the rest of your life. Consider the source. Interesting. I had somebody call and says, well, you're not a true fiduciary. I said, well, why? We offer all these. Well, because the guy on TV says you're not, because you have products that have commission. A fiduciary does what's right for the customer. And if the customer needs a product that happens, do you need a house? You pay a commission when you buy a house. Maybe a fiduciary may say, oh, we don't sell houses because we only do stocks and bonds that have a fee. We won't sell you a house because it has a commission. Well, the thing is annuities and things have commissions, but they don't have ongoing fees. Everything has a cost. And just because you're a fiduciary doesn't mean that you can't provide the right solution to a problem. So again, it's just funny, the frame of just the angle that some of these companies take that say somehow their way's the only way. The fact is I'm going to be the first to tell you, my way's not the only way either. No way's the only way. Your way's the only way that makes sense to you. And let's figure out a plan that makes sense and based on history isn't going to ruin you if the market doesn't do what we expect it to do, or if it does what we don't expect it to do. In other words, be okay whether the market continues to go up, or be okay if the market doesn't do what we want it to do. Bottom line is it's your plan. A fiduciary or somebody should work for you. Monte Carlo is just one tool to kind of give you a starting point. But I will tell you, I've never seen a Monte Carlo simulation that we couldn't beat income on with less risk by using all of the rest of the tools. Now, if that isn't a true fiduciary, I don't know what is. True fiduciaries ought to look at maximizing your income, minimizing your taxes, doing best what's for you, and giving you more income to live on, not less income to live on, just because that's all they sell.
Sam, very good question. Thank you so much for listening to us in Tucson. And again, you can connect with Jeff by calling 520-780-9059. If you want to continue this conversation, of course, there's no cost and there is no obligation to that whatsoever. Jeff, next question is from Aaron in Casa Grande, and he says, one topic that I don't hear you touch on much is how pre-retirees might plan to position retirement assets as they approach the last 5 years or so before retirement, as to provide principal protection for their income floor to minimize sequence of return risk. How soon should one start? Would moving more risky assets into safer assets be prudent gradually from 5 years out? I'm 8 years from retirement, so this is something that I'm trying to be thoughtful about. Any wisdom from you on this approach would be very welcome.
Well, first of all, I think you've missed most of my shows because I talk
about that a lot.
I do. That's really the plan that I talk about with principal protection is for people. I always say it's better start early than never.
Right.
Or it's better start late than never, but it's really better start earlier. In fact, 5 to 8 years is a great time. I'd say 10 years is when you should start taking some of those profits off the table, turning them into guaranteed income streams. And you get a lot more guarantee starting early than you do by starting late and playing catch up. So yeah, I'm with you on that. Absolutely. If you're in your 50s and you're going to retire in your 60s, then you should start repositioning some of those assets. You've worked really hard. The market's at all-time highs. Every crash comes after an all-time high. There's probably going to be more crashes ahead, and you don't want to be in a market crash when you decide to retire and reposition all your assets at half the value they are right now. Maybe you take the first $1 million off the table and you set up an annuity program that's going to guarantee you $100,000 a year when you retire in 8 years or more. And then you continue to put into your 401k, get the company matched, dollar cost average back into the market, and you have another $1 million by the time you retire that you can use for discretionary items, and maybe even do the Roth version of it while you work. And that way, everything that comes out of that asset is a tax-free income. So maybe your first $100,000 minus deductions keeps you in a 12% bracket, and you might have another $60,000 or $80,000 a year you can take out tax-free from the rest of your money because it's in a Roth. Or maybe you do a LIRP. By the way, if you're 10 years from retirement and you're healthy, a LIRP might be your best retirement plan, probably better than a Roth in many cases, because it provides so many different angles of protection. One is it provides a spouse with income protection should you pass away early. It provides you or whoever owns the policy. In fact, if you're married, you should consider maybe one on both of you, where it also includes a death benefit that can be used for long-term care when you're older. It could be used for virtually anything. You can borrow against the balance of the account tax-free. It never generates a 1099, and it could create some predictable income that could actually beat what you think an annuity would pay, because you never actually remove the money from the account. It continues to grow and compound in the account on the cash value, and the money that you spend isn't gone. It's just borrowed, and it's borrowed against the death benefit that you get when you die. So in other words, you don't even have to pay it back when you live. So you spend the money, it's still in there growing, and you don't have to worry about much else. So come look at those options. The earlier you are and the faster you start planning, the better. I've never meant to not say that enough for everybody to know that's definitely the preferred way to plan. I think sometimes people don't plan until they're so on the brink of retiring. Then they kind of say, oh my gosh, I got this and this thing. Now what do I do? And they come in when they're just right up on the edge of retirement, or when they finally turn 59 and a half and they know that's the time they can finally move some of those assets out of the IRA or 401k and transfer them from a pension plan, for example, on what's called an in-service withdrawal, and maybe set up their own IRAs elsewhere that they can do on their own and set up some retirement planning that way. So most people find that the stocks and bonds and mutual funds that are available in a 401k plan aren't really a good plan when you consider they're either all at risk or don't pay very much interest. So again, if you can start using the tools that we always talk about and you can start them earlier, you'll be way better off than starting them late. So yeah, I'm sorry you missed that. I'm sure it's on a show, and I guarantee that if you log into our website and go through past shows, you'll find out I talk about it a lot more than you think. Maybe it's just you didn't hear it in the context that you wanted to hear it, or maybe I didn't explain that when I talk about taking profits off the table, it means you can do that anytime you have profits, not just when you're retired or after you stop working.
Aaron, good question. And again, our shows are podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll probably find that conversation somewhere in your search. Jeff, not a lot of time left for our final segment here. People take a look at their 401k. They're trying to hit a retirement number. They may be on track or they may not be. Is trying to hit an exact retirement number the way to be looking at your 401k balance?
Well, maybe. I mean, if you have already planned and you know what number it would take in order for you to redistribute those assets into the right buckets, like for income or for growth or for emergency funds and things like that, and maybe you already know what that number is. Thing is inflation might change that number. The what ifs might change that number. You might want to just say, okay, I'm going to retire at 65 no matter what my number is, and I'll just have to adjust my budget accordingly. But everybody gets annual checkups for their health. They take their car in on a regular basis, get service. They have a maintenance guy comes in, do their air conditioning, everything. But some people really don't take a look at that retirement plan and necessarily how it's invested. They just say, oh, I'll just wait till it hits the number, then I should be good. Well, who knows? It might hit that number in a market uptrend and then all of a sudden crash the day you retire, and then you're not really set as you thought you would be. So check your investments, check the fees, make sure your beneficiaries are good on that 401k, and also make sure that if you have a lot of risk exposure that could derail that plan, just because you're at a certain number and you're projected to hit a number doesn't necessarily mean anything. So it might mean you take some of those profits off the table, just like the last person in the question section asked, is when is it too soon to take profits? Well, if you're trying to hit a number, you don't even know if you're going to hit that number, if that number is going to stay intact, unless you put some of that money into principal protected assets. So maybe you take $1 million of that. Maybe you've got the 1.3 million, you're trying to hit 1.4 million. Maybe you take the $1 million and you set up some principal protected income accounts or LIRPs or things like that give you some tax savings and some predictable income in retirement. That'll get you close to the plan. And then you work another year or two, get the match on the company match, and see if you get that other 4.6 or $5 million, that's the number. That 1.46, I don't remember, that was an article or something like that said that was the average retirement fund that somebody would need to maintain the average income. But I've got people that could never live on 1.4 million because they've been so used to living on more. We've got other people that they wouldn't even know what to do with 1.4 million because they never had a bill. They've lived within their means and they don't even know how to spend $50,000 a year because their mortgage is paid off and all they do is like to garden. They don't have any expensive hobbies and they shop at Roth or TJ Maxx. So whatever, everybody's got kind of a different lifestyle, got a different need. Some people are totally happy with less and some people can't be happy even with more. So again, I don't think there's an actual number. I think it just comes with a plan, future projections. Remember, take some of that profit off the table as you near retirement. Keep adjusting and reviewing your plan as you get closer so that when you do pull the trigger and say, hey, I'm done, I'm not working anymore, this is my last day, then you know you've got your assets structured in a way that'll provide income, tax efficient income, protection against those what ifs that come along, long-term care, and leave a legacy plan if that's what you want to do. Again, it all starts with a plan. You've got to do that earlier rather than later. You can't do it after the fact. Planning is not a post-event action. It's a pre-event action and needs to be done as soon as possible, not as you finally have an event happen that reminds you that you need a plan.
If you'd like to talk to Jeff about your 401k, 520-780-9059. Jeff, out of time for this week. I want to thank you for your time. But as I do every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.